Picture this. You're sitting at your kitchen table, staring at your bank account balance showing $25,000, and you're thinking to yourself, well, this is nice, but I'm still 75,000 away from hitting that magical six-figure mark. What if I told you that, mathematically speaking, you're not 75% away from $100,000? What if I told you that you're actually sitting right at the halfway point, and the math behind this claim will completely change how you think about building wealth? My name is Nick, and I spend way too much time thinking about compound interest, exponential growth, and why most people fundamentally misunderstand how money actually works. If you're someone who wants to understand the real mathematics of wealth building instead of just hoping your savings account will magically grow, make sure to hit that subscribe button and give this video a thumbs up if it ends up blowing your mind. Now, before you start typing angry comments about how 25 plus 75 equals 100, let me explain something that will shift your entire perspective on money. Most people think wealth accumulation works in a straight line. Save $1, you're $1 closer to your goal. Save 10,000, you're 10,000 closer. It's simple addition, right? Wrong. Dead wrong. And this linear thinking is exactly why so many people give up on their financial goals before they ever see the real magic happen. Here's what actually happens when you understand the mathematics of exponential growth. Money doesn't just sit there doing nothing when you invest it properly. It starts working for you, earning returns, and then those returns start earning their own returns. This creates what mathematicians call exponential growth, and it's the reason why reaching $25,000 is actually much more significant than most people realize. Let me walk you through some numbers that will make this crystal clear. Imagine you decide to invest $500 every single month. That's roughly $125 per week, which isn't exactly pocket change, but it's also not an impossible amount for most working adults. We're talking about the cost of eating out a few times, or maybe what you might spend on various subscriptions and impulse purchases throughout the month. Now, assuming your investments earn an average return of 8% annually, which is actually quite conservative compared to historical stock market performance, here's where things get interesting. It takes approximately 3 years and 4 months of consistent monthly contributions to reach your first $25,000. During this initial period, the vast majority of that $25,000 comes directly from your own contributions. You're doing the heavy lifting while compound interest is still getting warmed up. But here's where the math becomes absolutely fascinating. To go from $25,000 to $50,000, it only takes an additional 2 years and 8 months. Wait, let me repeat that because it's important. It took 3 years and 4 months to accumulate your first $25,000, but only 2 years and 8 months to double that amount to $50,000. The acceleration becomes even more dramatic as we continue. Going from $50,000 to $75,000 takes just 2 years and 2 months, and that final stretch from $75,000 to $100,000, a mere 1 year and 10 months. Think about that progression for a moment. The first quarter of your journey takes over 3 years, but the final quarter takes less than 2 years. This is why reaching $25,000 represents such a crucial milestone. You've not only proven to yourself that you can consistently save and invest, but you've also built the foundation that makes everything else accelerate. The compound interest engine is finally starting to hit its stride, and from this point forward, your money begins working much harder for you. Let's break down what's actually happening inside your investment account during this process. When you first hit $25,000, roughly $20,000 of that came from your own monthly contributions, while about $5,000 represents investment growth. Not exactly life-changing returns yet, but you've established the habit and discipline that makes everything else possible. By the time you reach $50,000, the story starts to change dramatically. Of that $50,000, approximately $34,000 came from your contributions, while $16,000 represents pure investment growth. Your money has generated $16,000 while you were busy living your life, working your job, and probably not even thinking about your investment account most days. The acceleration continues as you approach $75,000. At this point, you've contributed around $46,000 of your own money, but investment returns have generated nearly $29,000. Your money is starting to work almost as hard as you are. And when you finally hit that magical $100,000 milestone, you've personally contributed approximately $56,000, but compound interest has generated $44,000. Nearly half of your wealth came from investment returns rather than your own contributions. Here's what makes this progression so psychologically powerful. During those first 3 years, when you're grinding away to reach $25,000, it can feel like you're barely making progress. The monthly returns might generate a few $100s in a good year, which is nice, but hardly life-changing. You might start questioning whether investing is really worth the effort, especially when you see that expensive dinner or vacation calling your name. But once you cross that 25,000 threshold, like something magical begins to happen. Your investment returns start generating thousands of dollars annually. In a particularly good year, you might see gains of $5,000 or even $8,000. Suddenly, the concept of your money working for you shifts from abstract theory to concrete reality. This is when people start to understand viscerally why patience and consistency matter so much in wealth building. The person who reaches $25,000 and continues their monthly contributions isn't just building wealth anymore. They're building momentum. Each additional dollar invested has more time to compound, and each month of returns gets reinvested to generate even more returns. The beautiful irony is that most people give up right before the acceleration begins. They look at their account balance after a couple of years, see that they've only reached $15,000 or $20,000, and conclude that building wealth takes too long. They don't realize they're abandoning ship right before the wind fills their sails, but like rain on ice. But there's another psychological factor at play here that we need to address. When you have $25,000 invested, you start to develop what I call skin in the game mentality. Market fluctuations that used to be abstract numbers suddenly feel very real when your account balance swings by $2,000 or $3,000 in a single month. This can be terrifying for new investors, but it's actually a sign that you're building real wealth. The key is understanding that these fluctuations are completely normal and actually work in your favor over time. When markets decline and your account balance drops, your monthly contributions buy more shares at lower prices. When markets recover, and they always have historically, those extra shares you accumulated during the downturn become incredibly valuable. This is why the journey from zero to $25,000 is so much more than just hitting an arbitrary milestone. You're not just accumulating money, you're developing the emotional resilience, patience, and long-term thinking that separates successful wealth builders from everyone else who gives up too soon. Think about what this means in practical terms. You're not just watching numbers grow in an account somewhere, you're fundamentally rewiring your brain to think like wealthy people think. And wealthy people don't think in terms of linear progression. They think in terms of exponential possibilities. This shift in mindset becomes even more powerful when you start recognizing these patterns everywhere in life. The first year of learning any skill feels impossibly slow. You're terrible at guitar, your Spanish sounds like you're gargling marbles, and your attempts at cooking result in what can only be described as edible disasters. But somewhere around year 2 or 3, everything clicks. Suddenly you're playing actual songs, having real conversations, and people are actually asking for your recipes. Wealth building follows the exact same pattern, except most people quit during the equivalent of the gargling marbles phase. They never stick around long enough to experience the clicking moment when compound interest takes over and starts doing the heavy lifting. Now, let's talk about something that makes this $25,000 milestone even more significant than the math alone suggests. It's what happens to your behavior and decision-making process once you cross this threshold. When you have $25,000 working for you, you start making different choices about money. And these choices accelerate your wealth building in ways that aren't captured in our neat mathematical projections. For starters, you become much more conscious about lifestyle inflation. That promotion at work that comes with an extra $1,000 per month, instead of immediately upgrading your apartment or buying a fancier car, you start thinking about how that extra money could turbocharge your investment contributions. You've seen what $500 per month can accomplish, so you're genuinely excited about what $700 or $800 per month could do. You also start developing what I call compound interest paranoia. Every unnecessary purchase gets filtered through a new question. How much would this money be worth if I invested it instead? That expensive coffee habit suddenly looks less appealing when you realize it's costing you not just $4 today, but potentially $40 in 10 years after compound growth. This isn't about becoming a miser Lionel with your money in never enjoys life. It's about becoming intent a way that most people never experience. You start distinguishing between purchases that genuinely add value to your life and those that just temporarily satisfy some impulse. The result is that you naturally find more money to invest without feeling deprived. But here's where it gets really interesting, and it's something that financial advisors rarely talk about because it doesn't fit neatly into their projections. Once you have significant money invested, you start taking smarter risks with your career and income potential. That side business idea you've been putting off suddenly becomes more appealing because you have a financial cushion. The opportunity to switch jobs for better long-term prospects becomes feasible because you're not desperate for your next paycheck. I've seen this pattern countless times. Like, people who reach $25,000 or $30,000 invested often experience what I call the confidence multiplier effect. They start negotiating harder for raises, pursuing higher paying opportunities, or launching businesses they never would have attempted when they were living paycheck to paycheck. This additional income gets funneled into investments, creating an upward spiral that makes our conservative projections look almost pessimistic. There's also the network effect to consider. People with money tend to associate with other people who have money, not because they're snobs, but because they share common values around delayed gratification and long-term thinking. These relationships often lead to better opportunities, whether it's investment advice, business partnerships, or simply being around people who normalize wealth-building behaviors. Let me share something that might surprise you about the psychology of reaching that $100,000 mark. Most people assume that hitting six figures will feel like some massive victory, like you finally made it into an exclusive club. But here's what actually happens. By the time you reach $100,000, you've become so accustomed to watching your money grow that the milestone feels almost anticlimactic. You're no longer the person who started this journey 5 or 6 years earlier. You've developed patience, discipline, and a long-term perspective that most people never acquire. The 100,000 doesn't feel like the finish line anymore. It feels like you're just getting started. You start thinking about 200,000, then 500,000, then maybe even 1 million. This is why the journey from 0 to 25,000 is so much more transformative than the journey from 25,000 to 50,000, even though they represent the same dollar amount. The first quarter of your wealth building journey changes who you are as a person. The remaining quarters just amplify those changes. But let's address the elephant in the room that some of you are probably thinking about. What if the market crashes right when you're building momentum? What if your carefully calculated projections get derailed by another financial crisis or economic recession? These are legitimate concerns, and they're exactly why understanding the mathematics of dollar cost averaging is so important. When you're consistently investing the same amount every month, regardless of market conditions, market downturns actually accelerate your wealth building. Those months when everyone else is panicking and selling their investments, your $500 is buying significantly more shares than it did during the good times. When markets inevitably recover, those extra shares you accumulated during the crisis become incredibly valuable. Historical data shows us that investors who continued their regular contributions through major market crashes like 2008 or 2020 ended up significantly wealthier than those who stopped investing during the scary times. The people who reached $25,000 and then panicked during the next downturn missed out on some of the greatest wealth building opportunities in modern history. This is another reason why that $25,000 milestone is so crucial. By the time you reach it, you've likely weathered at least one or two minor market corrections. You've seen your account balance drop by a few $1,000s and watched it recover. This experience builds the emotional resilience you'll need during more serious downturns. The person who has never seen their investments decline is much more likely to panic and sell during a major crash. The person who has $25,000 invested and has watched it fluctuate for several years understands that volatility is just part of the process. They're more likely to stay the course or even increase their contributions when everyone else is running for the exits. Now let's talk about something that most financial advisors will never tell you because it doesn't help them sell their expensive services. The real secret to accelerating past that $25,000 milestone isn't just about contributing more money. It's about understanding the hidden multipliers that most people completely ignore. First, there's what I call the tax efficiency multiplier. Most people throw their money into taxable investment accounts and then wonder why they're not building wealth as fast as they expected. Meanwhile, savvy investors are using tax-advantaged accounts like 401ks and IRAs to supercharge their returns. When you're not paying taxes on your investment gains every year, more of your money stays invested and compounds. It's like getting a 20 to 30% boost on your returns without taking any additional risk. Here's where it gets interesting. That $500 you're investing each month, if you're doing it in a taxable account and you're in a 22% tax bracket, you're essentially giving the government $110 every year just for the privilege of building wealth. But if you're using a tax-deferred account, that $110 stays invested and starts compounding alongside everything else. Over the course of your wealth building journey, this difference adds up to tens of thousands of dollars. The person who reaches $25,000 in a tax advantaged account is actually much closer to $100,000 than someone with $25,000 in a regular investment account. It's like they're playing the same game, but one person is using cheat codes. Then there's the employer match multiplier that blows my mind how many people ignore. If your employer offers to match your retirement contributions, even partially, and you're not taking full advantage of it, you're literally turning down free money. This isn't some marketing gimmick or promotional offer. This is your company saying, hey, for every dollar you invest in your future, we'll give you 50 cents or even a full dollar for free. Let's say your employer matches 50% of your contributions up to 6% of your salary. If you're making $50,000 a year and you contribute $3,000 annually, your employer adds another $1,500. That's $1,500 you didn't have to work for, save for, or sacrifice anything to get. It just appears in your account like magic. When you factor in employer matching, that journey from 0 to 25,000 becomes significantly shorter. Instead of taking 3 years and 4 months, it might only take 2.5 years, and the acceleration effect becomes even more pronounced because you're essentially getting a guaranteed return on your investment before the market even does its thing. But here's something that will make you laugh or cry, depending on your perspective. Studies show that roughly 40% of employees don't contribute enough to their retirement accounts to receive their full employer match. They're walking away from thousands of dollars every year because they think they can't afford to invest more money. It's like finding a $20 bill on the sidewalk and deciding to leave it there because you're worried about bending down. Now, let's talk about something that separates people who build substantial wealth from those who get stuck in the middle class forever. It's understanding the difference between saving and investing and why most people are doing it completely backwards. Saving is what you do with money you plan to spend within the next few years. Emergency fund, vacation money, down payment for a house. This money should be safe, boring, and easily accessible. High yield savings accounts, CDs, maybe some short term government bonds. You're not trying to build wealth with this money, you're just trying to preserve it. Investing is what you do with money you won't need for at least 5 to 10 years. This money should be working hard for you, taking reasonable risks in exchange for higher returns, stock market index funds, real estate, maybe some individual stocks if you know what you're doing. This is your wealth building money, and it needs time to compound. The problem is that most people treat their entire financial life like a savings account. They keep $50,000 sitting in checking accounts earning basically nothing because they're terrified of market volatility. Meanwhile, inflation is quietly eating away at their purchasing power year after year. They think they're being conservative and responsible, but they're actually guaranteeing that the flip side, they'll never build real wealth. People treat their emergency fund like an investment account. They put money they might need next month into aggressive growth stocks and then panic when they have to sell at a loss during a market downturn. They're taking unnecessary risks with money that should be safe and boring. So there you have it. When you hit $25,000, you're not just a quarter of the way to $100,000. You're mathematically halfway there thanks to the beautiful chaos of compound interest. The hardest part isn't the math or the market volatility or even finding the money to invest. The hardest part is staying consistent long enough for exponential growth to take over and do the heavy lifting. Start investing today, because 20 years from now, you'll either be thanking yourself or wondering what could have been.